Certainly, let's delve into more detail about futures and options in the stock market. Futures contracts. 1. Futures contracts are standardized financial agreements to buy or sell an underlying asset, for example, stocks, commodities, currencies, at a predetermined price on a specified future date. They are traded on organized exchanges. 2. Parties involved. Buyer, long position, commits to purchasing the asset at the agreed upon price in the future. Seller, short position, commits to selling the asset at the agreed upon price in the future. 3. Obligations. Both the buyer and seller are obligated to fulfill the contract when it expires. However, many futures contracts are closed out before expiration through offsetting transactions. 4. Leverage. Futures contracts typically require a margin deposit, which is a fraction of the contract's total value. This leverage allows traders to control a larger position with a relatively small amount of capital. 5. Common uses. Hedging. Hedgers use futures to protect against adverse price movements in the underlying asset. For example, a farmer might use wheat futures to hedge against falling wheat prices. Speculation. Speculators aim to profit from price movements in the underlying asset without owning it. They may take long, buy, or short, sell, positions based on their market outlook. Arbitrage. Arbitrageurs exploit price differences between related assets in different markets by simultaneously buying low and selling high. Options contracts. 1. Options contracts provide the holder with the right to buy, call option, or sell, put option, an underlying asset at a predetermined price on or before a specified expiration date. 2. Parties involved. Buyer, holder, pays a premium to acquire the option, giving them the right to exercise it. Writer, seller, receives the premium and is obligated to fulfill the terms of the option if the holder chooses to exercise. 3. Obligations. The buyer of an option can choose whether or not to exercise it, depending on market conditions. The writer, however, must comply if the option is exercised. 4. Risk. For options buyers, the risk is limited to the premium paid. Options writers face potentially unlimited risk, especially in the case of naked call options, selling a call without owning the underlying asset. 5. Common uses. Call options. Buyers use call options to profit from anticipated price increases in the underlying asset. Put options. Buyers use put options to profit from anticipated price decreases in the underlying asset. Covered calls. Investors write call options against stock positions they already own to generate income. Protective puts. Investors buy put options to protect their stock holdings from potential declines. Key differences. 1. Obligation. Futures contracts have an obligation to buy or sell, while options provide a choice to buy or sell. 2. Leverage. Futures involve higher leverage due to the margin requirement, potentially amplifying gains and losses. Options have limited risk, premium paid. 3. Flexibility. Options offer greater strategic flexibility due to the variety of strategies that can be constructed using calls and puts. 4. Expiration. Futures contracts have fixed expiration dates, while options have expiration dates but can also be traded before expiration. 5. Common uses. While both are used for speculation and hedging, options are commonly used for income generation and portfolio protection. Trading futures and options involves a risk and should be approached with careful consideration and, ideally, a good understanding of the underlying markets and strategies. Many traders and investors use these derivatives to manage risk, speculate on price movements, and diversify their portfolios.